Imagine opening a letter from HMRC and discovering you owe tax. Not because you got a salary raise, and not because you sold expensive shares, but simply because you were responsible enough to save your hard-earned money. It sounds unbelievable, but right now across the UK, thousands of savers are falling into this exact trap. And in 2026, it's getting much worse. Here's the shocking part. Your bank might be paying you more interest than it did a few years ago. You see that extra cash coming in and you celebrate. But that exact same interest is quietly pushing you over a tax limit you probably don't even know exists. And once you cross that line, HMRC wants its cut. Most people think tax only applies to your salary, your business, or your property. But in the UK, your standard savings account can create a massive tax bill. Because interest rates have jumped in recent years, everyday savers are triggering tax for the very first time in their lives. This is all because of the Personal Savings Allowance. If you're a basic rate taxpayer, you can only earn up to £1,000 a year in savings interest tax-free. If you're a higher rate taxpayer, that allowance cuts in half to just £500, and if you're an additional rate taxpayer, you get absolutely nothing. Zero. A few years ago, when banks paid 0.5% interest, nobody cared. But today, with accounts offering 4% or 5%, you hit those limits incredibly fast. Every single pound over your allowance gets taxed at 20%, 40%, or even 45%. The biggest mistake people make is comparing bank accounts based only on the advertised interest rate. They never ask the question that actually matters: how much money do I actually get to keep after tax? Let's run the real numbers so you can see how dangerous this is. Imagine you've worked hard and saved £60,000. You put it into a high-interest savings account paying a solid 5%. At the end of the year, your money makes £3,000 in pure interest. Sounds amazing, right? Well, if you're a basic rate taxpayer, your allowance covers the first £1,000, but the remaining £2,000. HMRC will tax it at 20%. That is £400 snatched straight out of your pocket. If you get a promotion or earn over £50,270, you become a higher rate taxpayer. Now your allowance is just £500 out of your £3,000 interest. A massive £2,500 is now taxable at 40%. That means you owe HMRC £1,000 in cash. You are literally being penalized for being good with your money. Before I show you the legal, HMRC-approved way to completely bypass this tax trap, make sure to hit that subscribe button right now. If you want to master UK personal finance and stop losing money to silent traps, join the Wealth Ledger family today. So, how do wealthy UK investors protect their cash? They don't use offshore accounts. They don't use shady tax loopholes. They just use a different type of account wrapper called an ISA, an individual savings account. Every single adult in the UK gets a £20,000 ISA allowance every single tax year. Think of an ISA as a legal shield. Any interest, capital gains, or dividends earned inside this wrapper are 100% invisible to HMRC. If you take that same £60,000 and move £20,000 of it into a cash ISA paying 5%, that portion makes interest completely tax-free. No 20% tax, number 40% tax, you keep every single penny. A cash ISA is perfect for your emergency fund or short-term goals because your cash is safe, accessible, and shielded. But if you are serious about building long-term wealth, a cash ISA isn't enough. Even at 5% tax-free, inflation is still eating away at your purchasing power over time. To actually beat inflation, you need the second option, a stocks and shares ISA. Instead of earning basic bank interest, a stocks and shares ISA allows you to invest the £20,000 allowance into globally diversified index funds or ETFs. Over the long term, historical data shows investing has the potential to grow your wealth much faster than cash. Yes, the market goes up and down, which means it's a higher risk, but the tax rewards are massive. If your portfolio grows by £50,000 over the next decade inside an ISA, HMRC cannot touch a single penny of your profit when you withdraw it, but simply opening an ISA isn't enough. Thousands of UK savers still lose money because of four critical mistakes. Mistake number 1. Leaving large amounts of cash sitting in standard, taxable bank accounts just because you're too lazy to move it. Mistake number 2. Ignoring the April 5th deadline. Your £20,000 ISA allowance is a use it or lose it deal. If you don't use it before the tax year ends, it vanishes forever. You cannot roll it over. Mistake number 3. Chasing a high headline interest rate without checking your after-tax return. Always calculate what you actually keep, not just what the bank advertises. Mistake number 4. Confusing saving with investing. Saving is for short-term security. Investing is for long-term wealth. A smart financial plan uses both. The UK tax system is designed to penalise the uninformed and reward the prepared. Leaving your money in the wrong place is essentially tipping the taxman. It's time to stop paying the laziness tax. Go check your bank statements today, see how much interest you're earning, and look up your allowance. If this video brought you value, please smash the like button and drop a comment below. Are your savings currently sitting in a regular account, or have you already moved them into an ISA? Let's talk about it down there. I'll see you over there.